As one of the most sought-after companies in the world, Tesla has always been able to attract a lot of attention. So, is now the time to dig in or to leave the party? Is the EV evolution just starting, or has the bubble already bursted without us really realizing it? Whether you like or hate it, Tesla is probably a topic that is here to stay. Hello everyone, how's it going? I hope that you had an amazing day and lots of profitable trades. In this video, we're going to talk about Tesla and see if it is the right stock for you. As we know, over the past few years, things haven't always been looking good or very rosy in the job market. Companies once considered as safe havens for those seeking employment have been reducing their workforce, sometimes cutting entire departments, leaving a lot of people traumatized by this experience. At the same time, the rapidly rising inflation has been eating people's savings away in many parts of the world that have only known deflation for the known past. When every assumption about the reality is getting blurry, we must seize those opportunities to start working towards our own financial independence. In order to secure our own financial future, we have to find the growth opportunities of tomorrow and to use them to multiply our capital exponentially, increasing the money available for other investments, and also to find the next golden goose. We need to find the next big thing indeed, and for a very long period of time, Tesla has been what people are looking for. If the past few years in the stock market has taught us anything, is that Tesla is definitely one of the biggest names navigating these exciting and yet volatile waters. One of the major advantages we have when choosing more well-known company like Tesla in any given field, in fact, is that they tend to be the first to react to any macroeconomic changes or announcements, as many see companies of such a scale to be representative of the market appetite for risk. Industry-wide catalysts, changes for central bank interest, and any major event may affect or trigger any sort of major volatilities in companies like Tesla. Of course, given Tesla's own size and its significance from both a psychological, symbolic, and fundamental perspective, it is very important to have a deep and broad analysis on what the company is truly about before we decide to have a Tesla position in a portfolio. In today's video, we're going to take a deep dive into Tesla and to see if it's a decent choice that would fit with your portfolio. Before the video continues, I want to take a moment to thank you for coming to my channel and hope that you're going to enjoy your stay and to come back for more content. If you like what you see, please consider to like, subscribe, and to check out my channel for playlists of other companies I may cover. With that being said, I hope you're going to enjoy my analysis today, and let's get started. Currently, Tesla is trading around $182 after having tried but failed to go beyond the $200 level. So this is the result of a lot of market uncertainties and the lack of positive catalysts that have left the company in a very mixed landscape. For tech stocks in general, for EV stocks more specifically, but for Tesla as well. The main appeal of EV stocks is that they had the capacity of being a capital placeholder during the dark days of early 2020 before taking off in the subsequent 12 to 24 months or so. People have been begging for such an opportunity to come up again, and for many, just being qualified as the next Tesla would suffice for many EV stocks or startups to create new billionaires in the making. Of course, nothing is free, and that includes our dreams. The bubble has only lasted for a period of time before sending billions of capital down the drain. We can definitely see Tesla remaining above a certain threshold with a pretty high baseline, but there's a clear lack of steam for the continued upward momentum efforts. The EV legends are no longer, and the market needs new, convincing, and fresh narratives in order to create any upward momentums. On the 6-month scale, we would be able to see that Tesla is currently positioned at the tip of a bearish channel begging for recovery, after having an overall decline of almost 25%, which, despite its choppiness, seems to have found a kind of bottom for the time being. In fact, if anything, this might be one of the upsides of trading a stock that has a significant market cap. People don't want to bet too much against it, and the sell-offs tend to have a lot of support levels due to the power of brand image, and also the hesitance of the ones selling, as well as people who want to just YOLO in because they think that they're scooping the bottom. Now, I'm not saying that they're right for doing so, but a lot of people just do that. Thus, that is a reality. So, for options traders, the key strike prices to watch are currently around $180 to $185 for the calls options, and between $170 and $175 for the put options, with significant volumes going to both calls and put options. Of course, there's still plenty of advantage for the call options in terms of demand volume, but the market is definitely less one-sided than before. And understanding the relevance of options in trading stocks is crucial. Options provide investors with the right but not the obligation to buy or sell a stock at a predetermined strike price within a specific period. These financial instruments can be used to hedge against potential losses or to speculate on future price movements. For Tesla and many other stocks, the options contracts play a vital role in managing risk, maximizing returns, as well as selecting which kind of exposures they want to have. Do they want to long a position, or do they just want to pay the premiums to see if there's going to be volatilities to come? So the strike prices indicate levels where significant market activities will be expected, potentially influencing the stock direction. Tesla's current position in the market remains at a decently high level, characterized by a sideways but overall bearish movement in the medium term. This stability is attributed to the market's lack of clear direction. Considering the recent trends in option strike prices, I would recommend to enter the market currently and allocate some of your capital to play around in a strategy of straddle. Fundamentally, Tesla stands out as a significant player, reflecting both promise and challenges of a retail investor. Examining the dynamics surrounding this EV giant would provide us a lot of valuable insights for those considering to include this in their portfolio. Now, of course, historically, people need to identify high growth opportunities, and this is one of the main reasons why we're talking about Tesla to begin with. With its dominance in market share in the promising or relatively promising EV sector, it kind of aligns with that demand. The electrification of automotive industry represents a transformative shift, and Tesla's position as a frontrunner places it at the forefront of potential high returns for investors. But people like us also face a lot of challenges, which may impact our ability to capitalize on these opportunities. The most common hurdles include the lack of time to conduct thorough research, limited technical knowledge required for in-depth stock analysis, and the overwhelming array of low-yield financial products offered by people who want to package them as interesting financial solutions. So, Tesla's attractiveness originates mostly from its status as a dominant player in the EV sector. As the global push for more sustainable and environmentally friendly transportations has been growing, Tesla's market share becomes increasingly valuable, and the company's innovative technologies, its commitment to greener initiatives, and a relatively charismatic or at least special leader have contributed to its standing as a symbol of the electric revolutions. With that being said, just like any other stocks, Tesla has its own downsides, which arguably are being played out. One aspect that might be especially concerning is the potential for Tesla's growth prospects to be already priced into the stock. High expectations can create a scenario where a meeting or exceeding them becomes like very difficult, leading to potential disappointments for investors. So another thing is we are uncertain about the mood swings or sometimes the market swings of its CEO, Elon Musk. His many tweets and public statements have been known to impact Tesla's stock price, creating a level of unpredictability for investors. Musk's vision and leadership have been vital in Tesla's success, but at the same time, his unpredictable behavior, and I want to say increasingly so, can also introduce an element of risk that investors should consider. So there are a lot of ups and downs in Tesla stock that we should navigate through, and we gotta have like a balanced but relatively optimistic approach. Basically, we should leverage available resources to stay informed about the market trends, potential risks, and the broader economic landscape. Simply put, if we decide to get in Tesla, we should have a relatively positive outlook about the future relevance of the EV sector in the world economy, as well as a relatively good certainty about the preservation of the existing world order. So what do I mean by this? Regardless how much Tesla is considered as a tech company, they act and operate very much like traditional car manufacturers and obey the same rules of the heavy industry. Meaning, if anything starts to disrupt the supply cycles, then it's only a matter of time before the operations of Tesla will become seriously hindered. If there's something that happens in the main markets of Tesla, which are on multiple continents, if those continents stop talking to each other, then it's also a matter of time before the sales will dwindle. If people start to have doubts about EV as a narrative, then that for sure is going to have a major impact on the brand image as well. So going in, we need to have these assumptions. EV is here to stay. Tesla is going to remain dominant in. So right now, the global markets are facing a complex interplay of factors that have the potential to significantly influence the equities worldwide. In this speculative analysis, I believe that the consequences of the global inflation, surging commodity prices, and declined quantitative easing, as well as the rise of inflation rates or interest rates, plus the geopolitical instabilities, are going to play a significant part. The increasing inflation rate has been putting pressures across the globe, threatening the purchasing power, raising the input costs, and impacting corporate profitability. Companies operating internationally may face challenges in managing rising production costs and also to sustain profit margins. Those dynamics could trigger market volatility as investors adjust their risk-return expectations. The upward trajectory of commodity prices, including energy, metals, agricultural products, have been having far-reaching implications for various sectors of the global equities market. The companies heavily dependent on these commodities may experience squeezed profit margins, potentially affecting stock valuations and investor sentiment. The reduction or the end of QE's quantitative easing measures by the central banks worldwide may have resulted in reduced market liquidity. So this in turn could lead to higher borrowing costs for companies seeking capital, which may also discourage investment activities or will. The elevated market volatility plus the reduced investors' appetite may also continue to occur. Now, the central banks around the world are tackling this delicate situation of balancing the inflation rates with the economic stability and, if possible, growth. Central banks opted for aggressive interest rate hikes to combat inflations. Borrowing costs for companies have been rising, which has also slowed down business activities and also fueling the market's volatility in terms of the equity prices. Now, ongoing geopolitical tensions, including trade disputes, political uncertainties, and social unrests, will inject an additional element of volatility into the global markets. Investors may adopt a cautious approach, shifting towards safer assets, impacting the equities. Additionally, the escalating conflicts may disrupt supply chains, negatively impacting the performance of international companies. Given the interconnectedness of global markets, the aforementioned factors have reverberating effects on the US equities market. Companies with significant exposure to international market may face a lot of headwinds resulting from the economic slowdowns, disrupting the supply chains and the currency fluctuations. But nevertheless, the US market is known for its resilience, and the diverse sectors may attract investors seeking safe havens. So, really, the current landscape is characterized by global inflation, surging commodity prices, reduced quantitative easing, rising central bank inflation rates, geopolitical instabilities, and also ongoing lack of certainty regarding growth. While the US market may exhibit relative strength due to the safe haven status, it's going to remain interconnected with the global economic landscape. For long-term investors, these conditions may offer opportunities to identify undervalued companies with strong fundamentals and international diversification. With that being said, short-term trades should be approached with caution because of the increased volatility and uncertainty. And also, we should be careful when assessing individual companies, sectors, or regions. So, having said all this, my recommendation for Tesla is to be relatively cautious. I don't think that the previous narratives of Tesla or EV taking over the world is still going to be here to at least, push the EV stocks even higher. So my recommendation is to start accumulating like a small position right now and to see where things are going to go. And this position needs to be such that even if Tesla were to collapse another 30%, it's not going to affect significantly your operations. So overall, over the course of the next couple of years, I would say that the maximum capital allocation can be between 10 to 15% of your portfolio if you're a risk-oriented portfolio. But if you're not, then I would recommend to just stay away from it or to consider more mature or proven sectors for investments. Because going in, you would have to assume that things are going to be well for Tesla, or things are going to be good for the EV sector, and that we're going to mostly have the same kind of world order or the structures governing its trades and political landscape in the next couple of decades. If that is not really your assumption, then I would recommend to look elsewhere for better options that may suit your profile.